Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. It is market recap time for Friday the 13th, October 2023. All right, this morning, banks came out. The big banks on Wall Street came out with their earnings report, and oh boy, it's game over. It is absolutely game over. Game, set, match, checkmate. Use whatever analogy you need. But the macro noobs, your monetarists, your Austrians, your neoclassicals, whoever you are, if you're not an MMTer, you have to take the L this morning. You are likely scratching your head. You can't figure it out. But this has been choreographed, months in the making. Banks way better than expected on earnings this morning. And when you dig into the details, it gets even more wild than that. We're going to take a look at that again. Another big W for the MMT hype train. We're going to check out banks' earnings. And we're also going to take a look at inflation today. But before we get going, make sure you hit that subscribe button, turn that notification bell on as well. And if you find this video particularly helpful, give it a thumbs up on the way out. All right, we're going to kick things off taking a look at inflation. CPI data coming out yesterday. 2 months in a row now. 2 months in a row, back to back. Inflation coming in a little hotter than expected, a trend that we were anticipating would maybe start to take place. I probably thought maybe end of summer we start to see inflation really rear its head again, but it is starting to pick up here. And again, this is all in line with kind of core MMT theory in terms of how interest rates work under a floating exchange rate regime. So we're seeing this pattern play out. Overall, not a terribly concerning inflation report. We did see markets kind of rally right after the reports for about a half an hour, only to sell off kind of heavy Thursday, and then ultimately in today we had a little bit lower print. But overall, not an end of the world inflation report, but we are starting to see that hotter than expected momentum gain steam here. And again, it all comes down to that kind of core MMT theory that we're going to see inflation converge with a policy rate. Why is that? Above all else, the reason for that is that the higher interest rates go, yes, that causes the term structure prices to go higher. Yes, that makes the future cost of doing business more expensive. But it also adds, in our instance right now, trillions of additional interest income to the private sector. I've done extensive research on this topic, and if you're interested in that research, what you need to do is head on over to my Twitter page, link in the description below. Go to the pinned tweet, and I've got some great threads. The first one is, if you just go to the thread called inflation, it'll show you some of the causality statistics work that I've done in the past. Scroll down, read through that. You'll find out that there is a causal link between interest rates and the inflation rate, and it's not the direction that you think. It is the interest rate causing the inflation rate. And if you scroll down a little bit further in the pinned tweet, you'll see the definitive guide to rates and MMT, and there I explain in a little bit more detail how the whole higher rate cycle things happens. And as you can see, I mean, this was done back in June, and we're we've been seeing all of this come true step by step. We continue to see what MMT has been saying will play out, and the inflation is starting to tick higher. I think how this is going to end, and I actually tweeted this out yesterday after the CPI print happened. We had this back-to-back hotter than expected CPI, and how I'm seeing this is inflation, the 2022 inflation wave that we had, that was transitory, and that's done. The transitory wave is over. Had the Fed not come in and hiked rates, maybe we would have even went to recession. But at the end of the day, the transitory wave is over, and we would start to see inflation settle out. We are now in a new wave of inflation. This wave of inflation is going to be structural, and it is going to be imposed by this backward Fed policy of higher interest rates, which is ultimately just adding trillions in interest income to the private sector to support the higher prices. Is it going to get out of control at this point? Probably not. We're going to need to see oil really take off. I think that's a distinct possibility. But at this point, it might stay tame for a little while. But if the Fed continues to keep their foot on the gas, on the interest rate gas, and keeps fueling this fire, we could start to see this thing get out of control as we enter, late 2024. We could see inflation really spiral higher, and that is how the process works. So inflation hotter than expected, right in line with what we were thinking would eventually play out, and we're starting to see see the signs that that we're going to see this kind of echo wave, a Fed-induced echo wave of inflation pushing forward. All right, now to the headlines for the banks. We saw JPMorgan come out better than expected. Profits, they topped their profit expectation on higher rates. And interestingly, they talked a little bit about the credit situation being better than expected. And that's what I want to jump into in just a second. But I want to show you the headlines from Wells Fargo as well. Wells Fargo stock popping out of the gate. Obviously, markets as a whole were down, but they too topped expectations for Wall Street. Citigroup as well, better than expected. Third quarter revenue. So banks doing way better than expected. Remember, the macro noobs, right? They all thought that banks were going to have a real tough go of it because of the higher interest rates. But again, everyone missed the next step. Everyone understood the first knock-on effect. Things are going to get more expensive. Yeah, great. Congratulations. You passed the first grade of economics. What are some of the knock-on effects? Do you have the capacity to understand all the dynamics at play? If you do, you'll understand that when interest rates get pushed higher, the Treasury has to pay that higher interest rate. And we're seeing that play out again in that additional interest income. And the banks are loving that additional interest income. And this is stuff that we have been pointing out for a long time. I gotta shout out my good friends over at the Applied MMT podcast. Ryan and I sat down, and Adam sat down for a conversation all the way back, their third podcast under the new Applied MMT name back in February. Ryan was making this argument, this exact argument back in February of 2023. I then had him on a few months later to our live stream. This was back in, 4 months ago. Again, Ryan spelling out exactly what has played out to this point, that the banks were going to do far better than anyone was expecting, and we are seeing that play out. Kudos to Ryan. Super smart guy. Make sure you follow them on YouTube. Find them over on YouTube. Find them on Twitter. They need to be in your follow, your bookmark, whatever. Make sure you're getting notified by them, because they absolutely nailed this. So kudos to them. And then another, I don't know if he's an MMT or directly, but certainly MMT adjacent, understands kind of the MMT structure. W.A. Buffo over on Twitter. Bill, awesome find in the earnings call. Question: where are you seeing softness in credit, either consumer or commercial right now? JPMorgan, we're not seeing it anywhere. The consumer is doing better than anyone expected to this point, and it makes complete sense. Going all the way back to that Twitter thread, one of the things that I realized months ago, years ago, really at this point, is that yes, just because things are going to get more expensive doesn't necessarily mean that there's not going to be the income to support that higher expense. And that's exactly what we're seeing. We're seeing a trickle-down approach happen. Now, I want to be very clear. It's not the way I would construct things. I don't like how regressive this is, but it is still what is taking place. We're seeing a trickle-down economy. Again, not what I would want. I think we should, if we're going to use the fiscal space we have, it should be at the bottom and let it trickle up, right? We should make the top earners earn it. We shouldn't be giving it to them for free, but that doesn't matter from the macro perspective. It's still working. It is trickling down. We're seeing things like strikes. We're seeing calls for higher wages. And that is one of the things in this thread that I point out, that there is an acceleration of wage demand that follows the interest rate higher, because everyone knows things get more expensive when rates go up. And there is the additional income that is out there in the form of the interest income that is coming from the higher rates to support that higher term structure of prices through that income channel. So that is exactly what is playing out at this point. And it's playing out in droves, surprising everyone except for the Applied MMT guys. And we just continue to kick butt. All right, that is all I have for tonight with the headlines. Look, I think this cycle is just getting started. I think we're still headed much higher here. I think the growth will continue to surprise going forward, again, all because of this additional interest income coming from the higher interest rates. Yeah, we're just getting started here. We're having a ton of fun. Make sure you get subscribed. Notification bells on. Hit that like button. But that's all I got for tonight's update. So until next time, good trading, everyone. And we'll talk to you then. Bye-bye.